You identify a pristine historical liquidity zone. You map the boundaries perfectly. But when price actually reaches it, the structure splinters and fails. To understand why this happens, look at the traditional order block. It is strictly a historical map. It shows you exactly where unmitigated limit orders were left behind prior to a past displacement move. The vulnerability lies in how traders interact with that map. Leaving a blind limit order resting at a historical boundary assumes those past buyers are still present. During high volatility sessions or thin overnight hours, that assumption is a liability. Without active institutional absorption stepping in to defend the level, price doesn't hold. It slices directly through the unverified zone, triggering passive entries and crashing through to the stop loss. Relying on historical data without real-time verification introduces unnecessary drawdown risk. High-probability trading requires splitting the process into two distinct disciplines. You must separate your market location, the historical map, from your execution timing, the real-time engine. A static map looks at a single time frame and hopes for a reaction. But a structural execution model requires a dynamic multi-time frame engine to definitively prove that the specific location is actually active right now. We use a verification layer called the True C Matrix. This is a three-factor algorithmic filter built to confirm institutional intervention before capital is deployed. The matrix demands sequential, real-time proof. It requires directional momentum, verified volume, and clear structural displacement before a trade is executed. Effective execution requires moving past static levels toward dynamic multi-time frame microstructure confirmation. We begin with a strict operational rule. Never execute a trade at the immediate outer boundary of a macro order block. Isolate the 15-minute chart and map the 50% equilibrium midline, the center of institutional gravity. Price must settle deep into this midline to shake out early retail liquidity. Once anchored, we step down to the 3-minute microstructure to start verification. Isolating the macro equilibrium midline establishes a tight containment zone. With the location locked, the stage is set for micro-level validation. The True C Matrix filter demands 3 specific micro-level triggers. The first is real-time micro-momentum. In the lower panel, we track the fast C-wave oscillator. When this indicator hooks sharply upward, it signals an immediate shift in order flow, showing that buyers are initiating market orders. Momentum alone is not enough. The second requirement is volume verification, governed by the principle that price movement requires capital weight. Price movement without accompanying volume lacks the conviction to sustain a reversal. Without a surge in participation, the move is often just noise. To validate the institutional footprint, we require the current volume bar to aggressively breach its moving average baseline. When micro-momentum aligns with a confirmed volume surge, it indicates a statistical anomaly. This helps separate true institutional footprints from standard retail traps. The third and final filter required to trigger an execution is ATR displacement. A candlestick that leaves a long rejection wick looks like a bounce, but wicks alone represent a lack of structural commitment. Price was pushed back, but buyers failed to hold the territory. We require physical candlestick body expansion. A body that expands away from the midline indicates that buy-side market orders are overwhelming the available sell-side liquidity at that specific price. The matrix is strictly sequential. Momentum, volume, and displacement must align in real time to validate the zone. This 3-factor algorithm systematically removes guesswork. It takes a theoretical macro support zone and transforms it into a confirmed execution trigger. When all these variables align, we arrive at the nested True C execution setup. A nested setup occurs at the moment of microstructure convergence. It is defined by all 3 3-minute filters firing simultaneously as price interacts with the 15-minute equilibrium midline. At this point, the market variables are aligned. Macrostructure holds on the higher timeframe, precisely as micro-momentum accelerates on the lower timeframe. This shifts the trader's role from prediction to reaction. Instead of attempting to catch a falling knife, you are executing only after the market has demonstrated a structural shift. By requiring the convergence of macro location and micro confirmation, the nested setup aligns multiple independent variables before capital is at risk. It bridges the gap between the historical map and the real-time engine. Signal generation is only the first phase. The second is mechanical trade management. The absolute entry rule is fixed. Execution occurs strictly on the close of the confirmation candle. You never enter during its formation, because the data is not confirmed until the candle is complete. The defensive boundary is placed immediately below the sweep wick low. If price breaches that level, the structural setup is invalidated. For the take profit, targets are anchored at unmitigated liquidity pools or prior regular trading hour highs to ensure mathematical expectancy. This approach prioritizes asymmetrical risk. By using a microstructure invalidation point to target a macro-level expansion, you reduce the high drawdown exposure inherent in the passive model. It all comes back to a core operating rule. Never trade location without timing, and never trade timing without location.